Wall Street keeps breaking records, but this week it's going to have to earn it. Hello everyone, welcome to Good Morning Trading on Tuesday, July 7th in the year of our Lord 2026. A trader speaks to traders. I wanted to thank Anton for the beautiful painting he sent me. Art historians are still going to study the style. It's contemporary, but still has a touch of neorealism. So here you have Antoine's Gad. Here, the big guy, CHRC, whom I thank for the color, that's me, Benoist. So we can see that Antoine really has a sense of proportion. Here, these are others. These are other traders, some little collages also related to the world of trading. Well, listen, thank you very much, Antoine. I'm really touched. I'm going to put it in the library. I think I'm going to take down the Kandinsky. Kandinsky really doesn't fit in well. And put up Antoine's instead. It's going to look great. So thank you very much. Thank you so much, Antoine. That's really nice. All right, we're going to keep going. But you can still send me one if you have an extra Kandinsky. Don't hesitate to send it to me. I'm sure I'll find a little spot for it. And if you have a Picasso from the blue period, please. The rest is a bit overrated, but the blue, extraordinary. All right, move on. No, I'm being totally serious here. Let's keep things serious. So, this Tuesday we're kicking off the big earnings season. In fact, analysts are expecting profits to rise by more than 20% for U.S. stocks. So, the market is already very expensive. Be careful. Any disappointment could be costly. The Dow Jones hit a record high yesterday. It's at its peak. We're right at the moment when earnings season is starting. Watch out, they're expecting that 20% increase. If someone comes in with just a 19% or even a 21% increase, they could still be disappointed, even though that's an exceptional profit growth. They could be disappointed and take a bit of a hit. Even if a company posts a very good result on the stock market, that doesn't necessarily mean that it's especially appreciated by fund managers. You always have to remember, they want just a little bit more. And for stock market enthusiasts, that little extra sweetener, they'll get what I mean. And then, should I give you a little riddle for the road at the end? I'll let you think about it in the meantime. How do you beat expectations for 20 years straight, down to the last cent in the markets? That's what we're going to look at today. This week, actually, there are three fundamental issues at stake. We have earnings season kicking off, and we have the Fed minutes coming out on Wednesday. And then there's credit, which I think is deceptively calm right now. We'll see some pretty impressive statistics. Quick overview of the markets. Yesterday, we were especially watching for SpaceX's big debut. The verdict? Let's just say it was more of a soft landing. The rocket gained barely 1%. It's high, it's very expensive, And like I told you, you're not just buying SpaceX. And you get burned. Maybe, like me, this guy has been a market seller for 14 years. He knows that to sell mushrooms, you have to mix the good ones with the bad ones to move the merchandise. When you buy SpaceX, it's not just SpaceX, he slipped in some other stuff too. Maybe one or two of those mushrooms aren't exactly fresh. That's why investors didn't rush into SpaceX. On Wall Street, though, it's a historic high. Dow Jones hit a new record at 53,056 points. Everything's fine. The S&P also went up, and the NASDAQ jumped more than 1%. Why? Chips, always chips and more chips. AMD gained more than 6%, Broadcom over 3%, and All American. It stayed calm, Sage at 4.47%. Yesterday in Europe, well, nothing really happened. We're still on the same track. The CAC 40 went down, the DAX went up. There you go, that's totally normal. And today's little barometer for May is credit. We're going to look at high yield spreads, basically the rate paid by weaker companies. The lower this rate is, the more confident the market is about the future. Even for weaker companies, the market is willing to lend money. And today, this spread, let's call it high yield, this risk premium, is around 2.75%. Basically, if you have a risky company, meaning it's heavily in debt and you're venturing into somewhat shaky territory, you'll get a loan at 2.75%, which is absolutely ridiculous. We're almost at a historic low. So right now, you could start any kind of company and still get a loan. For anything. Just as a reminder, during COVID, it went up to 11%, and in 2008, that extraordinary year for traders, we went over 19%, almost hitting 20%. So right now, there's so much money that we're lending to lame ducks. If you have something a little weird or so-so, there's almost a 75% chance it'll go through. We're not sure about the 11%, we're not sure about the 20%. Be careful with finances. Absolutely everything and maybe anything goes. I lived through the dot-com bubble, and this kind of reminds me a bit of that. So yes, there's a bubble, everyone knows it. The question is, when will it burst? It's like a balloon you keep inflating and inflating. You never know when it's going to pop. So right now, what you need to understand is that the market sees, since it's lending at 2.75, that there's absolutely no danger. The Fed is breaking records, giving its blessing. Let's go. Always higher, always further, always faster too. But this is where I'm telling you, be careful. The slightest tension could be a warning sign. They might stop lending to everyone and anything. So today's topic, we're getting there, it's the big earnings season, as I just mentioned. This week, companies are opening their books, and we'll see what they've done over the last 3. The last 3 months, Wall Street has been at its all-time high. I've already told you, and I'll say it again, now the profits need to follow. And yeah, guys, if you want, for the past 3 months, by the way, I'm scratching my nose for those listening to the podcast. If you hear a weird noise, that's the sound of me scratching my nose. Okay, so for 3 months, they kept telling us everything's great, it's fantastic, it just kept going up. Now, if they have results, it's not just wishful thinking, it's not a maybe, it's something real. Hey man, did you make money or not? And your dividends, how much are you giving me? So profits have to follow, and dividend payouts have to follow too. Like I told you, the consensus is expecting an increase. Overall, for all mid-sized companies, for all the S&P 500 companies, more than 20%. That means whoever comes out with. If someone only posts 15% profit growth, they're going to take a hit. And then if someone does 22, 23, 24, 25%, that's pretty much what was expected. If someone comes out with 30%, that could be a big deal, and the company's stock could really jump. But for me, the weakness is that everything actually depends. This whole increase is based on just a handful of giants. There's the green giant, the blue giant, the red giant, there are tons of giants. They're tech and energy companies, and they're pretty much carrying everything on their own. And let me remind you, the market is already trading at 21 times earnings. So even the slightest disappointment could hurt a bit, to the point where, well, on the S&P 500, we really have 2 camps facing off right now. On one side, we have the research firm Yardeni. Its founder, Ed Yardeni, he didn't try too hard to come up with his company's name. He's targeting 8,250 points on the S&P 500, about a 9% increase from yesterday by the end of the year. He thinks there's still room for another 9% upside. He's talking about a tremendous surge in profits. Come on, he's living it up. He sees life through rose-colored glasses. And then we've got Bank of America, you say. We've got some analysts, and we've got an American bank. They're much more cautious, since the American bank sees the S&P 500 at the end of the year at 7,100 points, which is about a 6% loss from current levels. So is it more? Is it less? Honestly, we don't know. And that's because the American bank sees a lot of warning signs, especially since we're trading at 21 times earnings. We're at all-time historical highs. They need to deliver more than 20% just not to disappoint. Wow, that's a lot. Now it's like they have to run the 100 meters almost every time in under 10 seconds just to keep up the momentum. So, as I was saying, it's starting to get risky for Bank of America. Listen, the first verdicts are coming in this week. We're starting with Pepsi-Cola, and then we've got Delta. So we'll be focusing more on the Dow Jones, PepsiCo, and Delta, 1 year apart. So we've got consumer goods, we've got transportation, and then all the banks after that. So it's really more about the Dow Jones. We'll have to wait about 2 to 3 weeks to get the tech results and see how they did. Let's move on to technical analysis. Here we go. I just need to find a button. There, that's the button. Okay, great. All right, let's go. So basically, we're looking at there we go. Sorry, we're on the NASDAQ now. So yesterday, we saw a slight uptick. The monthly pivot point held things back. We tried to break through 2 or 3 times, got knocked back a bit, and now, overnight, they're being cautious, they're being careful. We went above 30,000 on Monday, and now, as I'm speaking to you at 8:21 and 53 seconds, it's back at 29,167.0. And we just bounced off the 28,000 to 28,600 range. Actually, it was a little trade I took, but honestly, I didn't make anything. It pays for lunch, and it's not even a fancy restaurant, so I made a 6.6, really nothing at all. I was just in front of it. You know, it's something you can still pick up. So be careful, because now people are starting to say, maybe we're a bit too high and all that on the NASDAQ. There's a bit of doubt. Here you have the 15-day view, and over 15 days on the NASDAQ, we're stagnating, and we're actually closer to the week's lows. And if you take a bit more perspective, over 2 months, well, it's not great at all. Basically, over 2 months, we haven't made any progress since May 11th. We've been in stagnation mode for 2 months. There have been big highs, there have been small lows, and right now we're more on the small lows. So be careful with the NASDAQ, which could trip us up. People are starting to say, well, maybe we got a little too cocky, now we'll have to see some real results. On the Dow Jones, all-time record highs, and above all, it's holding at those all-time highs. So maybe we're seeing the start of a rotation. Tech stocks are very expensive. We're cashing out of tech slowly, not too fast. We don't want it to drop too much. And then we're putting money back into something solid, like PepsiCo. Well, actually, this isn't PepsiCo, it's Monster. This is a free ad for Monster. If they want to sponsor me, no problem. Ham 2 to 3 times a day. So that's 1,200 Monsters a year, so they shouldn't hesitate. Monster, the drink of traders. That's the idea here. In any case, it gives you energy when you need it. And your liver appreciates a Coke. All right, okay, that's enough. No need to tell me not to drink it. I know, I do it, and it makes me feel good. Well, I don't know if it actually does me good, but at least, it's not stopping me. But I also have Japanese green tea. Oh, thank you, Damien. He's the one who sends it to me. He's my official supplier. So where are we at? The Dow Jones super high. Let's look at it. It's the highest point from last month. We hit it, we bounced, we hit it, we bounced again. That's a sign of strength, as long as we're above last month's high. It becomes a support level, it means they want it. They really want it. So still, be careful. We've got PepsiCo coming out with results, and that might make them hesitate. But here we're on a train. We're not on Bitcoin one. Here we're on a train at the all-time historical high. For me, I'm chill, so things are going really well on the Dow Jones. Quickly, I'm checking the time. I need to finish in 5 minutes, which seems impossible, but we're going to do it anyway. On the Dow Jones, no, and also the S&P 500. It's also moving up. It hit last week's high, but unlike the Dow, it's not stabilizing above it. That was its stopping point, and it's dipped a little bit from there. There are a lot of tech stocks in the S&P 500 too, so you can see there's kind of a sense of doubt around tech. It's actually the NASDAQ. If you look over the past 2 months, that's at the lowest point, in quotes, among the 3 main American indices. And we have a very clear chronological dynamic order. The Dow Jones is the most dynamic, number 1, then second is the S&P 500, and third is the NASDAQ. Let's hope that all those like Facebook, Meta, Alphabet, Nvidia, give us good results. Otherwise, we're going to feel it pretty quickly. Gold has bounced back nicely. It really bounced back from 4,000 to 4,200. It gained 5%, so that's very good, very good. It had been stagnating for about 2 weeks right around 4,000, which is still a psychologically tough barrier to cross. Now it's made a little rebound, which shows us it's in good shape. Bitcoin is above 60,000 points, so it's also trying to show us that it's in good shape. And that's the case. It gained 5%. We're not there yet, though. It had lost about 30 to 35% in 2 months, and now it's trying to bounce back a bit, putting itself back in the middle of its very low range from June. It erased a month of doubt, so that's good. Well done. That's positive. As for our little oil, well, listen. Below $70, you haven't seen it at the gas station yet, but it'll get there slowly. Don't worry. $70, like I always say, $70 to $75, that's a gentleman's agreement. Everyone agrees, the buyers are happy, it's not too expensive. The sellers are happy too. It allows them to fund their social systems. The Gulf monarchies are very social, even if, the nitpicky and super annoying little observer on the internet, because only nitpickers do that, is the WTI. But it's exactly the same thing. I'm not going to bring up all three, Brent, WTI, and Arab oil. I'm taking the one that's traded the most, WTI. So if WTI is at its lowest, all the others are doing fine. That was the right answer. Everything's fine, so let's do a quick rundown. Well, the CAC 40 is the only European index that went down. But that's normal. It was at its highest. And let me remind you, look. We have the highest point of the year, which was surpassed by the CAC 40. That is truly impressive. France is performing exceptionally well right now, even though it definitely wasn't a sure thing just a short while ago. 2 months ago, we couldn't stay above 8,000. It was tough. Now we're at 8,500. Yes, because there are some really great stocks in the CAC 40 that are going to deliver very good results and are generally quite generous with dividends. That's so investors don't run off to the United States. Stay with us. That's kind of the message. Stay with us. Anyway, that's what they say in the CAC 40 circles. So when it comes to dividends, they're usually not stingy. The DAX is also at its peak and its highest point of the year. And honestly, we're in a good spot right now. We're doing well, and I've told you about everything. I still have 2 or 3 minutes left to talk to you about today's agenda. It's a pretty quiet day in terms of statistics. The real event, as I already mentioned, is on Wednesday. The Fed will release the minutes from its meeting. The behind the scenes of the last vote, we see what they discussed, who voted for and who voted against the rate hike. The rates. It lets us see the tension between the members. Here, we're going to see a rate hike coming soon. If 30 to 40% of Fed members already wanted to raise rates at the last meeting, there's an even greater chance that if 1 or 2 more join them, it could tip the balance. Now, for today's anecdote, let's go back and dive into something big. We're talking about Wall Street legend here. Back in the 1990s, or around 90, General Electric was impressing the world. Every quarter, the company beat analysts' expectations. Not always by much, often just by a single cent. They kept raising dividends from $10.28 to $10.29, then $10.42 to $10.43, just to keep analysts happy. And it's a little too consistent. The only thing is, this whole setup seems maybe a bit too perfect to be true. And after the departure of General Electric's iconic CEO, he was so iconic that I forgot his name. It's Jacques Welch. Let's just say that's it. Jack? No, it's Welch. That's it. Jack Welch. There were a few small doubts that started to surface. The stock market regulator eventually launched an investigation. And in 2009, General Electric paid to quietly settle the matter. The lesson here is, listen, an earnings per share that's a little too perfect always deserves a bit of skepticism. We don't know any more than that. It was paid, the case is closed. It's between the regulator and General Electric. All right, let's sum it up. I think the key word here is caution. The records are there, okay, it's amazing, but it's still fragile as long as the evidence is missing. Now we get to the evidence. Show me your balance sheet, my friend. And as for credit, it's so calm that it's actually reassuring. If they're willing to lend at 2.75 to any company, it means that for now, people who are stronger than us, smarter than us, think there's no risk in the markets. But sometimes, people who are smarter, more brilliant than us, and there are a lot of them, because honestly, we're kind of at the bottom, make mistakes. And in those cases, that's just how it is. That's all. Now, what matters is looking at the numbers, the company's results. We're no longer in the realm of imagination, no longer in illusion. We're dealing with the concrete. I always read the proof of the truth comes every quarter when we open the books. Thank you for sharing this moment with me. Sending you a big kiss. See you tomorrow for good morning training and lots of good things. Bye to all of you, and thank you, Antoine.